Temenos markets itself as the banking software company. We, as the team representing the University of Bern, challenge this confident statement and would like to present to you why Temenos rather is just a banking software company. As the digitalization of banks is the #1 industry topic, banking software is at the center of discussion. The majority is still spent bank internally, as many banks stick to in-house solutions. Nevertheless, the highly competitive third-party market will grow going forward. To meet the modern requirements of banks, Temenos has built up a broad product portfolio with Transact and Infinity as their most important revenue drivers. So, all well and good, we say no and issue a sell recommendation on Temenos with a target price of 108 Swiss francs and a downside of 26%. It's time to face valuation reality, and here's why. 1. Temenos bets too much on its future growth in the Americas. 2. Innovation is not as good as it seems at first sight. 3. The shift from licensing deals to software as a service, or in short SaaS, causes uncertainty regarding margin development. And 4. Governance issues increase Temenos' downside risk potential. Daniel will now elaborate on why Temenos' shift to the Americas will not bear the expected fruits.
Historically, Temenos' home market Europe has been the company's main source of revenues. However, with the Americas accounting for over half of global market size and currently being least penetrated by Temenos, the company hopes for strong growth in this region, especially in the US. Temenos has been trying to capture the US through various acquisitions and partnerships. Through those deals, Temenos experienced strong growth over the last years. Yet organically, the company has not even grown in line with the market. The acquisition of Kony in 2019 for a record high price is the most recent attempt to finally enforce the breakthrough in the US. However, Kony clearly is no perfect fit to Temenos' strategy, with over 30% of customers being non-banking clients. Furthermore, Kony is known to be a US SaaS leader. Let's take a look at why this is a problem. Temenos wants to build momentum with Tier 1 and 2 banks. Yet software licensing revenues from those clients have stagnated. As CFO's Biliopoulos statement shows, the SaaS leadership of Kony does not improve Temenos' market position for the top-tier banks. Both Kony's SaaS expertise and Temenos' strength in standardized software are more attractive for smaller banks. Temenos, in consequence, will mostly miss out on its targeted Tier 1 and 2 clients, and American revenues will remain below aspired levels. Despite the questionable strategy, we project the high efforts in the Americas to transform the region into Temenos' main source of revenue growth. Together with the realization of postponed projects due to COVID-19, this will enable total revenues to recover to pre-crisis levels quickly. However, as those two effects prove to be temporary, growth will slow down in the long run. While in the past, Temenos was able to meet or even exceed its guidance of 10 to 15% revenue CAGR, future growth rates will fall below the high expectations. Temenos, therefore, will remain just one among many banking software companies, rather than becoming a market leader. We have just seen how a questionable strategy in the most promising market impacts Temenos' revenues negatively. Joel will now explain to you why organic growth will slow down even more due to a lack of innovation.
Temenos spends 28% of its revenue on R&D, which is almost twice as high as its closest competitor. This effort should result in the development of new and innovative products. Shockingly, this was not the case in the last 5 years. The only product which has been developed in-house is country model banks. But this is rather a country-specific customization of the existing product portfolio than a new product. The high R&D investments seem to be necessary in order to keep the broad portfolio up to date, rather than developing innovative products. Acquisitions have often been the driving force behind growth and an expansion of the product portfolio. Through the active M&A strategy, Temenos significantly levered its balance sheet. This resulted in a net debt to EBITDA ratio of 2.3 in 2020, very much opposing the trend of competitors to have little to no debt. Because Temenos wants to reduce this ratio, such an aggressive M&A strategy will no longer be possible. Without the help of M&A and with very limited internal innovation, we are convinced that Temenos organic growth will fall below 5% CAGR in the midterm and almost disappear in the long run. So, despite high R&D spending, the lack of internal innovation and the limited future M&A potential will slow down growth. But enough of unsatisfying growth prospects. I will now present to you why the ongoing shift from software licensing to SaaS causes margin uncertainty. As the management said when presenting the Q3 results, SaaS is expected to start cannibalizing some licenses going forward, which leads to deferred revenue streams. With SaaS, the client does not buy the software with an upfront payment, but rents it and pays periodically. In addition, the vendor login effect decreases due to the higher standardization of SaaS. When a company shifts from software licensing to SaaS, a margin bump occurs, as software companies like Microsoft and Adobe have shown. The problem is that no one knows how deep margins will fall and when they will recover. We clearly see this by the analyst consensus still projecting growing margins, while Temenos speaks of a negative impact on the EBIT. This significantly raises uncertainty in the short term, which we implemented by adding a risk penalty of 0.1 to the equity beta. So the shift to SaaS causes uncertainty, which leads to a risk penalty. Let's now hear from Rahel how the ESG analysis impacts our risk assessment.
Temenos achieves solid ESG scores according to Refinitiv and MSCI. Sounds promising, right? Well, 2 governance risks should change your opinion. First, 86% of management's compensation is variable and mainly tied to non-IFRS KPIs, which are not based on any comprehensive set of accounting rules. Our concern is that management would not have reached their bonus targets by IFRS measures, leading to alarming management incentives. Shareholders see this critically as well, as the say on pay approval rate has decreased to relatively low 80% over the last years. Second, Temenos has gone through multiple changes of key personnel while integrating Kony and battling COVID-19. Compared to other Swiss companies, Temenos stands out with a high rate of refresh, which lowers leadership stability, especially in these uncertain times. In short, the governance situation is a key risk and increases Temenos' downside potential. Colin will now illustrate our valuation results.
The cash flows of the DCF model are discounted with a WACC of 7.3%, derived by the CAPM and the average yield to maturities of the issued bonds. The terminal growth is made up by weighing the expected GDP growth rates by the regions in which Temenos will generate their future revenue. The classic sensitivity analysis reveals that in only 9 out of 49 cases, we end up with a buy. 65% of all cases support our sell recommendation. An even clearer image emerges from our second sensitivity analysis, where we examine changes in the EBIT margin and revenue growth. We analyze different up and downside risks regarding our valuation. While a high long-term revenue CAGR of 15% or an unexpected US market breakthrough would change our recommendation, the price distribution is clearly downward skewed. To make the comparison in our multiple valuation reliable, we adjusted the earnings for the R&D spending respectively. Utilizing a forward PEG ratio of 2.13 leads to a high downside of 46%. Looking at how we conducted our sell recommendation, we used a weighted approach of the discounted cash flow and the multiples assessment. Putting these two together, our resulting target price amounts to 108 Swiss francs, which implies a downside to the current market price of 26%. So, since the growth prospects of Temenos are overestimated, the shift to SaaS is not yet included in the market price, and we find a troubled governance situation, we recommend that you take this wake-up call and don't invest in Temenos. Thank you for your attention, and the floor is now open for questions.
Thank you. Judges, please turn on your video. Stay muted unless you are speaking. I will start time as soon as the first judge utters the first word. Time will end at 10 minutes. Feel free to begin.
Thank you. Can you, if you go back to the beginning of the valuation slides, can you elaborate on the cost of debt versus the risk-free rate that you have used as inputs?
Okay, so if you could go on the slide, excuse me, that would be the 24. You meant this slide, right?
Yes.
Okay, so our cost of debt is based on the market prices of the issued bonds, and we use the weighted average of the yields that the bonds have outstanding, and the risk-free rate is based on the 5-year forward-looking 5-year treasury rate, which is 2.1% at the moment.
Okay, and what's the rating of the company in terms of credit? You mentioned they have bonds in the market, right?
Right.
What's the general credit rating of the company?
So we looked at the credit rating, but due to the fact that we couldn't assess a fair rating, we used the approach of valuing the bonds according to the market price, and then looking at the yields that are outstanding to use as a fair value of the cost of debt. Okay,
thank you.
Hello, team. Thank you so much for your presentation. Quick question from me. The company had the Capital Markets Day just recently, and they talked about the future growth. Can you please help me understand where you stand compared to the company guidance? And don't you think that everything is already priced in, given that the shares are down 20% from peak? Thank you.
Thank you for the question. Rahel, can you please go to slide, this is slide, I think it's slide 14. Yes, exactly. As you can see here, we compare our forecasts of the growth rates, revenue growth rates to the management guidance. And the management guidance for the next 5 years, they expect that the revenue will grow at a rate of 10 to 15% per year. And of course, the stock price rose so far, so we are convinced that they will not be able to get these growth rates, and therefore the stock price is too high, and these lower growth rates we project are not yet included in the stock price.
Thank you.
I'll go next. So thank you very much, team. From my experience, there's a trend in the financial services and banking sector where more and more banks want to not rely so much on their own infrastructure and software internally. They'd rather outsource, and this is very obvious from a number of banks signing global agreements with data providers, cloud providers, and so on and so forth, right? How do you see this trend to be impacting your valuation and also the future price of Temenos as well?
So Rahel, if you could please go to the slide market development, which would be exactly right there. So we have included the outsourcing of the banks in our market forecast overall. So we let the third-party banking software market grow faster than the total addressable market. We increased the share of the third-party market of the total addressable market by the implied share that Temenos uses in their forecast. Meaning Temenos forecasts their market, total addressable and third party, to increase about 1/4 percentage point every year. So that's what we did in our forecast as well, increasing the share from about 27% right now to 30% in the long run. We froze the market characteristics at the moment as due to the uncertain situation with COVID-19. We believe that there's kind of not more outsourcing going on at the moment. In 2020, there was already quite a huge jump in the outsourcing, with banks outsourcing due to the higher need to digitalize. So now over the next year, there's not going to be that much outsourcing, but then in the long run, yes. And then as we used kind of the different regions to forecast total revenues for Temenos, so we forecasted them by each region separately. We then assessed Temenos' opportunity to participate in this growth in every region separately, and thus included this forecast into our total revenues forecast. So it affects them positively, but due to their bad positioning, especially in the Americas, they will not be able to participate in the growth as much as they would like to.
Thank you very much.
Why do you think they've been so ineffective in terms of their R&D, or what's your perception of that, and what would you like them to see? I suppose there's a risk that they get it right.
So we would see that management has to really narrow down on their most profitable products, which is Temenos Transact. That would allow them to also reduce R&D spendings. And we think that is the way to go for management. And that would also be a reason by which we would then assess our seller combination again and take into account if it could turn into a hold.
Can I ask you a question on valuation? You showed multiples, but you didn't show which companies you're comparing Temenos to. So who are their main competitors?
Thank you for the question. So the competitors that we used for our multiple valuations are these three. These are Jack Henry, Intellect Design, and Oracle Financial Services. We didn't include more because it's quite difficult in this industry to find peers that are good for comparison. And we know that like the statistical noise is quite high if you just include 3 years, but we are convinced that this is a better way than including peers which are really not similar to Temenos.
Does the company pay any dividends? And I have 2 questions. And have you done any sensitivity analysis for your valuation?
Yes, here will be the sensitivity analysis. And what would be your specific question to the sensitivity analysis?
No, the first question, does the company pay any dividends?
Yeah, so if you could go to slide 72, Rahel. The company currently in 2020 pays 90 cents dividend per share, and Temenos has constantly increased its dividend over the last years, and we expect this to continue like this moving forward. However, dividend yield with this 90 cents per share is only at about 0.6%. So it's really not an attractive dividend yield. So Temenos sees itself more as a growth stock, and they declare themselves as that. So they say they do not want to pay high dividends right now, as they would rather reinvest the money. However, we see dividends increase moving forward, as that's what happened in the past. And also we believe that Temenos will do so in order to compensate shareholders for the worsened outlook.
Okay. Thank you.
So team, I have one more question. So you highlighted ESG as an area of concern, right? You pointed out employee turnover and high variable compensation as well. So have you looked at how does that picture look like for the peers in the industry overall?
Yes, so according to the remuneration, we can see that Temenos actually compares to other Swiss companies. Well, if you work for Temenos, quite favorably, but from a shareholder's perspective, you have to take into account that total executives almost earn twice as much as the average of other Swiss companies. Then for the turnover of the board of directors, we also see that this is very much higher than the average of other Swiss companies. Temenos has a turnover rate of around 29%, and the average for other Swiss companies is around 13%.
Thank you.
Thank you so much.
Have a nice day.
Thank you so much.
Bye.